Low warriors. Who's ready to trade the consumer pain index?
The clean pants index.
Yes. I know you're ready, Ryan.
Always ready, mate. Always ready.
I know. So, going into it, can you guys see my chart?
Yes, mate. Yeah.
Okay. All right. So going into it, little pullback in euro and pretty good pullback in Aussie. Are you still holding Aussie longs here, Ryan?
Yes, I am.
Okay.
Yeah.
All right. So, looks like, so far just a correction. What are you thinking here?
Yeah, that's pretty much what I'm thinking too. I won't go so far as say as I'm hoping.
Yeah.
I was saying when we hit those highs and we couldn't break through my big zone 65, 20, 40, you've got to look at things in reality. And I said, if we fail here, we're likely to have a steep pullback. Bit disappointed to see 64 going, although it's not decisive just yet.
Yeah.
But if you can't go up, you're only going to go down, and it's how far you go down to. So we're finding a bit of a halt right in the middle of the range, sort of thing. So yeah, we're not broken yet.
Are you disappointed about the lack of acceleration in US dollar yen? Challenging these lows and not being able to make any headway to the downside here.
I wouldn't call it disappointed because
just trying your patience.
Yeah, I'm expecting it. I was expecting it. Still short a little bit from up top. We knew 145 is going to be a big level. So on that aspect, it's done exactly what it should have done. I would have liked to have had a proper test of it a bit closer. But I'm still bearish, but I'm expecting it to maybe range for a little bit, between 145, 148, 149, that sort of thing. Because until we get something that changes the narrative, the Bank of Japan's still going full tilt easing, the Fed are going full tilt hiking. Until that picture realistically changes, we won't probably get a break of range unless something gives us that to break it.
Well, maybe that's today. We still have a failing rally, but a hot number could push us to 440, a good number, and I think you have a high in yields, which I think builds a case for short yen, US dollar yen. But we could also have one more push up if it's a hot number, 440, 450, to give you a 1, 2, 3. So to me, it's a coin toss right now.
It's the beauty of trading, though. You've got all these levels. We've set these levels over a decent amount of time. Those are levels you watch. If we don't break those levels, you know what to do.
Right.
You know what to do.
Okay.
That's the way it works.
All right. So I want to bring K-Man in if he's here today.
Yes. Good morning, Dale. Good morning, everybody.
Any follow-up on Ryan's comments about the yen?
No, but that's exactly it. I think a weak number will be an accelerator for dollar yen to the downside. I think a strong number could see other pairs more affected, because then we are going to go back into what Kuroda said, any 200-300 pips moves, especially to the top side, is a bit overdone. So if we take anything 148 and above, could be attracting some stealth or other interventions, providing that it's not a blowout number and taking the dollar much higher versus everything. Could be a bit limited. I've got a little bit of an option running at 147. Already covered a little bit of it, so I'm ready for any side really. But I think coming back to Aussie and Kiwi, if we get a weak number, I think the commodity currencies may go faster than others.
And why is that? Why is that?
Well, because there's always those committees going on in China as well, and the data, although RBA is a bit mellow, but the data in Australia and Kiwi land are not really dropping away. So perhaps they have a little bit of an advance or an advantage versus the rest. And I'm also thinking about the metals, because the metals are holding very well. In a weak number, I think silver and gold can really rally. And in case we get a really strong number, I think in turn stuff like perhaps euro dollar cable could be the fastest to go down. So that's kind of how I look at it. And then I'm paying particular attention to what's happening in Mexico, in the mix with the Banxico around tonight as well. That could be,
they're what they talking 0.75%?
0.75% to put it at 10, and that could give a double push in the Mexican pesos back if we get like a slightly weak one in the US and Banxico doing 75. The MEX pairs could be strengthening a little bit, but okay, I mean, those are the things that I will primarily look at for what's CPI and then the combination CPI Banxico later today.
Okay, so you know, this was a huge level right here, right? So
that one, yeah. And then there's another one just above 20, but I think that one already 1980s is already going to be a decent level. And if we break sub 1940 today and close below it, that's going to be a mega bearish signal, I think. And the same happens we have virtually the same levels in the euro mix, but it's not surprisingly because euro dollar is turning around parity. But even on the pictures, they roughly have the same levels in both pairs. So if it's not the dollar, I may be looking at Euromex or both or either of them.
Okay, hey, Tim. Well, one thing I could say is that we did, hey, Grega, we did confirm the low here on the daily. Little divergence here. Go ahead, Grega. I know you've been bearish MEX. Go ahead.
Yeah, I just wanted to add that it looks like that we are now consolidating for a wave 4, and that this recent drop from the last 2 weeks or so was a wave 3. So I think that this pair should remain under pressure as long as we are below 19.90. That's the invalidation level. As you know, wave 4 must not break into that zone.
So close enough to this horizontal blue line breakdown, which it tested here.
Yeah,
right.
Nice, yes. But now we are, as you can see here, this rise from the lows on you have this 4-hour chart. This appears like a wave A. So I would be looking for resistance to be retested around 1965, 1970.
Okay. All right. So wave 4 there in MEX. Have you changed your mind? Are you still, even after this rally, are you still bearish Aussie, where we could still get one more shot down?
I think that Aussie is actually, as you can see yourself, it looks like that it's building a bear flag here. If you draw the channel here, there is still.
You want to grab the charts, buddy? You're a better technician than me anyway, so let's give the crowd a treat to look at your charts. All right?
Sure, why not?
All right. I stopped sharing. They don't want to look at, you know, an old school technician when you have the Wizard of Waves here. See, guys, isn't that a better choice? Look at all that stuff there.
Yeah, sometimes confusing. Okay, so this is the channel that I mentioned. You can see that we have this very overlapping recovery. We stopped at the former wave 4 here, and we are selling off pretty aggressively. We haven't seen a break to the upside here. So this, for me, is quite concerning. And if today, after the US CPI, and then later for the US session, the US dollar would stay strong, then I would be even willing to short the pullbacks here.
You know, hey, Greg, I'm glad you brought up that chart. I'm going to, when you're finished, I want to show you what I'm looking at. And it actually freaked me out too, because I was long the Aussie into yesterday, but based on, you know, the way the market's moved and the dollar reversed, and then going into today, I'm actually really quite concerned about the Aussie dollar. But I'll show you what I'm seeing after you show us some of the things that are on your screen.
Yeah. So
okay, go ahead.
Yo, say.
Yeah. Okay. So we could have another pop up. A lot of people were looking for 66.40 before we had a failure. So that's what you're thinking that could happen. That would imply that maybe we get you know, not a hot number, but maybe a cooler number in the
markets.
Then the dollar comes out.
Markets could definitely be all over the place after the release. So for me, it's important to see where the markets will close after today's sessions. So if the Aussie will stay weak, no matter what the number will be, then I think that Aussie will see more weakness, because clearly it's struggling to gain. I mean, we had very nice move to the upside on metals, but Aussie, you can see it's not really coming to the upside. Also, what I'm looking at is German DAX. To give you just a quick perspective on stocks. So German DAX is actually bullish, but I can see it trading at the potential resistance here. So I have these levels marked at the 261.8% extension of a wave 1 measured from low of a wave 2. This is typical target for a wave 3. And you have also this important level back from summer of this year. So I think that this market will sooner or later slow down for a correction. And US stock market is much weaker. I mean, the S&P 500 compared to German DAX. So if German DAX will slow down, I think that the S&P 500 will have more downside. And if this would be the case after today's sessions, then I think that Aussie will suffer from that.
You know what a great observation that is the DAX, in case you guys aren't seeing it, because you can't see it on what Greg is looking at, because obviously he's looking at Elliott wave counts. The DAX is at the 200-day moving average. The S&P, as he was just pointing out, is well below the 200-day moving average. It's very much underperforming. So it's interesting.
Here it is.
Yeah, there you go. So you can see how it's right at the 200-day moving average. Very key, I think, for the S&P. And so your wave, or I'm sorry, for the DAX, but your wave count suggests that we should stop there. Is that correct?
Yeah, that we should consolidate, exactly. And then I would be looking, just if we stick the basic technicals, then those moving averages that were broken, 50 and 100, could potentially react as a support on the next dip.
Grega, would that translate into, say, about a 36.5 S&P, which is something I talked about yesterday when I turned negative? Could we get 36.50 in the S&P?
36.50.
Well, why couldn't we see that today? We could see that today if we had a hot number.
You think?
That's not the S&P.
Yeah, in the S&P. So we could see that today, Dale.
Yeah, that'd be okay.
That'd be okay with you. You're short.
13.
He liked it.
Let me check this. I shared this in chat from yesterday. Not this one. Just a second.
You keeping your position, Dale?
This one.
Yeah, half. I took half.
Good stuff.
I would watch this.
BE stops on half. No.
I would watch the 61.8% that comes to the 36.30. That was also the swing low back from wave 2, this horizontal support.
Yeah. Okay.
So if that's a counter-trend movement, this level should hold.
Yeah, I mean, then we have a rocket ship for a few weeks or a month, huh?
Wave C equals to wave A also in that area. So very nice support down here.
All right, thank you, buddy. Go ahead. I've talked enough, Blake. Go ahead.
Well, what I wanted to do is I wanted to show you alternately what I was looking at with the Aussie dollar, and then I want to get everybody's gauge on what they think is going to happen today, because we have about 15 minutes before this data comes out. So let's real quick go to the Aussie, and I wanted to show you this is how I've been trading it. And let me go ahead and actually make a slight adjustment here. Going into yesterday, Grega, I was actually trading it more as a triangle, inverted head and shoulder pattern nonetheless. But you can see that false breakout yesterday, and the whole crypto meltdown really impacted not only the Aussie dollar, but risk in general. And that, you know, pushed me to the idea that, hey, we actually have more of a horizontal neckline. So I guess in other words, I'm not getting bullish the Aussie until we break back above 65.50. I mean, if we break above 65.50, I'm going to be bullish, and I'll be looking for a move. Whoops, I didn't want to do that. I'll be looking for a move, you know, up towards, you know, 68, 69 cents in the coming, you know, weeks ahead. But for right now, that was a really big rejection, and now we're back into, you know, let me delete this. We're really back into this triangle, like right in the middle, like you know, just ahead of key data. You know, being in the middle of a triangle or a consolidation is very common. I mean, because it's undecided. The market's really kind of undecided at this point, and that's why I'm flat. I'm flat. I have no dollar positions going into the data. But that's how I was looking at the Aussie, and that's where my concern comes in, because this is, again, I'm going to show you, not only was it a false breakout above that trend line, but you'll also notice it was a false breakout above these highs. So that really sets up the bearish setup if we get very strong CPI. And I have to ask you guys this, because this is the question that everybody should be asking. What do you think is going to be the best reaction today? And my opinion is, if we have strong data, we're going to have the biggest reaction, because everybody's, you know, seeing inflation components and disinflationary data starting to come through. Everybody's thinking, quote unquote, thinking it's only a matter of time before CPI starts to weaken. And you can see the market starting to base. You can you go to the S&P and say, well, the S&P is really starting to base here. We've got this triangle setting up. You know, you've got gold popping. You've got the dollar starting to show some signs of weakness. You know, and you know that it might be topping. But I have to ask, what do you think the best reaction is going to be? My opinion would be, you know, strong data. We're going to see stocks really come under pressure, and we're going to see the dollar rip right back up towards resistance here. What do you guys think? And Ryan, what do you think about that? I know K-Man already bolted out to trade, and he's going to be updating the ForexAnalytix chat room. But what do you think?
Yeah, I think the upside for the dollar is the path of most resistance.
Path of least resistance or most resistance?
Most resistance.
So you think that the dollar down would be an easier way to go?
I think if the data's weak, it's going to go harder south than it would go north on strong.
Interesting. All right.
You
don't think the market's positioning for that?
No, because as I noted earlier, and again, you know, don't take this as a gospel indicator. We're still pricing 75 pip hike as the greatest probability at 55%. So the market hasn't shifted that much towards the Fed coming down in hike increments.
Yeah.
But look at what the dollar's done. Look at what yields have done since Powell had that hawkish shift.
Yields have dropped for sure. Yeah.
Yields have dropped. We've not made fresh higher. He effectively said we could go higher on the rate ceiling, and we've seen the opposite reaction in the dollar and yields. So the market is starting to call his bluff. I think he pushed the boat a bit too far with those comments. So if we get a strong number, the market's going to look at that and say, okay, fine, that keeps the Fed going. But are they really going to go up to a higher ceiling? Probably not, because the rest of the data is turning south. So yeah, I think it will be I think we'll see a pop in the dollar. I don't think it will last on that scenario. But I think if we get the core and the headline number moving down significantly, you know, maybe 3 pips or more, then the pivoters are going to come steaming in as they always have done. And, you know, they might get a bit more bang for their money this time.
Okay. Well, you know what? We haven't heard from Stelios. So Stelios, what do you think?
I think, first of all, my view is that there's a high chance for a stronger print than expected. 8-1, 8-2 maybe. I seem to be in the minority, but I'm
with you. I'm hoping the other direction, but I'm with you. I agree.
In that case, if we do get a strong number, dollar spikes, obviously, I think the way I would play that, if you want more bang for your buck, is to be short, to get short something like Ethereum or Bitcoin, because those things are going to move. And we've seen these rally back today. on some hopes of some somebody coming in to save FTX, but they seem to have done. I mean, I was reading the chairman.
That is a hope.
The guy apparently took money, client funds, to fund losses on their trading operations. I mean, that's just criminal.
That's about as criminal as you get. I mean,
yes, unless you're Corzine, but
it's amazing how he got away with it.
Yeah, but anyway, I think this is going to go most. Obviously, it's a high risk trade, but I think if we start seeing risk off on a strong number, I think that's going to go. So Bitcoin, Ethereum probably be my preferred shorts. The other way around, if we see a weak number, I like metals obviously being long, and I like $MEX being short, just like you do, Blake.
Yeah, and well, first of all, I love the way that gold's setting up, and I agree with you as far as if we have weak data. Now, a lot of people, still are in the mind frame of gold is an inflation hedge. Scratch that and get that out of your head. It's not. I mean, you want to see what, just look at what inflation's done for the last year and a half and look at what gold's done for the last year and a half. It is not an inflation hedge.
It's a medium to long term inflation hedge. Absolutely. Short term, it's not, because you get price movements that
it's the anti-dollar, right? So
yeah, it's
exactly.
monetary dollar.
Exactly.
Right. So but you have to look how it's set up. And I have to say the gold has the best setup right now for weak data. Dollar weekends, gold will pop. I mean, we've broken this, year-long or 2022 trend line. We popped through resistance. We are literally like just points away from breaking out, doing a double, triple bottom, whatever you want to call it, quadruple Lindy, backflip. It looks bullish here. So on weak data, and this is going to be on my screen as we cover CPI, weak data, gold goes up, dollar goes down. I do agree with you. My favorite trade it's been all year and most of you guys know that is the pound dollar moving lower. Dollar MEX moving lower. The dollar MEX has broken a long-term trend line, that spawns all the way back from 2017, and we're trading really heavy. And if we break below 1940, and as I've mentioned many times here, we should probably be trading back down in the mid-17s, as Mexico is going to really benefit moving forward and from a macro point of view globally. Whenever we get to the reflation trade, whenever that comes, dollar MEX or Mexican peso is going to be the star performer there. And it's got a great carry, by the way. So on weak data, dollar MEX, I agree with you. Now, what do you do if there's, let's say the data is strong and we start to see stocks sell off? Dale, what do you think? I mean, well, no, you're short. I can't even ask you that question because you're biased.
Okay.
I'm just kidding. No, what do you think?
Dale celebrates if
he'll celebrate. Yeah, he's gonna pop some bubbly. But what do you think, other than the S&P goes down on strong data? What else do you think happens?
Gold looks so good that I'm going to try scalp if we get up towards that what is it, 1730 level.
So you think you might get a knee-jerk reaction, a move up here, then down, or
1729-ish with maybe a $10 stop.
Oh, okay. All right.
So if you look at the last poke we had above 1720, and you go to maybe a little shorter term.
Right here.
It's setting up like a little 3 drive to a top formation. So
okay.
And maybe a retest of 1680.
Okay. Sounds good. Grega, what do you think if we have really weak data, and the stock market, well, actually, let's go back to the hot data. Let's say we got hot data and stocks come down. What's going to be your best trade, do you think?
As I said, Aussie short.
You want to play the Aussie short, and why I think the Aussie short's actually a good short. Not only because we had this little false breakout, but it's also a China play as well. I mean, if you look at, I got to show you guys these indices if you guys haven't seen them. Like here is the China 50, right? Here's the Hang Seng, and look at these failed inverted head and shoulder patterns on both those indices. China looks like garbage. And, we had some weaker CPI data this week. Producer prices are coming down. The way to play that might be through the Aussie dollar. So
what if CPI is, or I would say like that, if the US yields come to the downside, would anyone look for dollar yen shorts? Because no one is mentioning dollar yen.
K-Man's thinking the dollar yen short. I mean, this is coming out of an ascending wedge, a break below here, or below the 145 level, opens up downside. I think you got to stay. Whoops, I didn't mean to do that. You got to stay short dollar yen while. Dang it, I didn't mean to do that again. You got to stay short dollar yen while you are below this level right here at 148. Right, this level. That is where I would see is wedge resistance. So a break below here would be bearish, right?
Yeah, actually, I agree. I see a very nice consolidation here for a triangle that could break lower.
Yeah, exactly. All right, guys, we just have a few minutes. I thought Steve was here, but it looks like he probably jetted out for a meeting. I am going to get set up for CPI. Any last minute thoughts as we go into this data? Stelios, Dale, Grega, Ryan?
Just the one thing you got to look at, all the data. Does it change the Fed's mind? Does it change them from their path? So that's the main thing to look at.
What do you think? Expand on that thought.
Well, if the data is really, really bad, is it going to stop the Fed hiking? We know they're going to continue. So that's how you judge the data. Does it mean the Fed are going to change their mind on everything? Because that's going to bring the biggest move.
Okay. And I think, Stelios, were you just going to say something?
I was going to say something. We haven't talked about what happens if the numbers come in line. I think that a number that's in line, like 8% CPI, what is it, 6.5 core CPI, is probably going to get taken as a strong number, I think. So basically, inflation remains sticky. Yes, we're edging lower over the past 2 or 3 readings, but
it's not getting worse.
It's not getting. Yeah, that's the thing. But my personal gut feeling is that the market.
People are expecting, and people want CPI to roll over. No one wants persistently high inflation at these levels, right?
Yeah.
Not as we come into the winter time and you start to see energy costs start to go up because we have a really cold winter globally. I mean, no one wants to see them perched up at these levels. We want to see inflation coming down. So I think in line is just as bad as bad inflation, to be honest. But that's my opinion, Any other thoughts there?
Well, at least commodities came quite a lot to the downside over the last few weeks.
Yeah. Well, look at the dollar yen. The dollar yen is already starting to lean for weak data. So this is the problem because and I'll put it back over on the Live Squawk feed. And remember, guys, this is ForexAnalytix. This is part of what we do. If you guys are involved in the ForexAnalytix community, this is what it looks like. This is our chat room. This is our trades room. We have a macroeconomics room. You guys, lot of great communities inside of our community. But I want to say that the dollar yen's are already showing some weakness here. The dollar is coming under a little bit of pressure. I'm hoping for a weaker number. I mean, that's what I'm hoping for. But I don't know if we're going to get it. Let me pull up the data flash that's also included with ForexAnalytix with your subscription. You can see the data as it comes out. I'm going to pull that over. I'm going to pull our charts up. Let me put it on a 15-minute chart for the dollar index. I should probably be watching yields. Hey, Ryan, Stelios.
Yeah.
You guys make sure you guys keep an eye on what's happening with yields too. When I'm gonna keep the dollar, gold, S&P on here, and I am specifically watching gold because if gold goes up, I'm shorting dollars, and if gold goes down,
if you're watching yields, watch the 2-year. That's the important one.
Very good. We have, let me see, how much time do we have?
30 seconds.
30 seconds. You'll see all the data here.
Problem is what you said. You're hoping for a weak number. I guess everybody wants that because
everybody's hoping
because of the economy, because it has an effect on us all.
Yeah,
it's not just a number.
Hope isn't a trading strategy.
It is not a trading strategy.
So I think you're going to see people putting their money where their hope is.
Yeah, of course. I mean, you see all these false breaks that we got in the dollar yesterday, and people are going to hold them because they hope. They hope,
Yep.
right?
Okay, let's go.
Let's see it.
All right.
What we gonna do? Stocks are down. Strong data. Oh my goodness.
Is it?
Well,
no,
look at gold just ripping. The dollar is absolutely getting smashed here.
What's the number? What's the number?
7.7 CPI.
Wow.
Core
Okay.
6.3.
Woo!
Wow.
That's good. That's good. Well, hopium worked. Hopium worked.
Here come the pivoters.
I guess I was wrong on that one then.
Hey, you know what? That's all right. It's okay. It's okay not to have called it right. I'm actually looking right now what I want to be trading, and I am going to be buying some Aussie on dips now is what I'm going to be doing. I like it. Hey, let's watch the S&P here, see if the S&P can build on. I am going to be buying some gold today.
Dollar Mex about to break.
Yeah, let's go dollar Mex. I'm getting on the short side of that.
Dollar yen is breaking quite decisive.
What's that?
Dollar yen.
Dollar yen is really breaking below 145. That's right. And watch this dollar Mex. I think the dollar Mex is going to be probably the best play here. What's that?
Gold's blooming 1730s.
Yep.
2-year yield 4.41. So that's getting below the Fed's rough midpoint of the ceiling, 4.5%.
All right.
Wow.
Oh no, my trade station is not connecting, which is I'm actually selling dollar Mex right into the support, and I'll be selling more on a breakdown. So just so you guys all know, that's how I'm trading it, because I think the you can see how it's really underperformed over the course of the last. Can you guys hear all the uh-ohs? Can you guys hear that?
What?
Oh, you guys can't hear it. I'm getting these uh-ohs. I can't even trade on some of my platforms. But yeah, look at the dollar Mex, dollar Canadian's trying to break lower, dollar Norway's breaking lower. We are seeing a really good dollar reaction, and good. Hopefully we get, this gives the Fed some ammunition to actually slow down their pace. I mean, that's what we're all hoping for, right? Let's see the dollar, watch this dollar Swiss, because this has a double top, right? That should lead us back down towards 95 cents. Hold on. I'm trying to, I still cannot trade here. This is, if you guys use Oanda, just be advised that, there's no connection here, which stinks. I'm trading on, not Oanda. I'm sorry. On Gain Capital. Which if
you're in the flow show, we highlighted and just before here highlighted the Fed rate odds. They were 55% in favor probability of a 75 pip hike. And so that's now around a 50 pip hike is now 72.5%. 75.
Wow. Well, that's good, because then that means that whatever the terminal rate was, it is coming down, and so that we have to take that into account. Let me go ahead and I'm sorry, I'm trading via some other different platforms. If you guys don't have different platforms, you should, because for backups, this is exactly why I have backups. So Dale, I know you have an interview, but let's just say the dollar, watch these double top here in the dollar Swiss, Aussie dollar. Let's say the Aussie dollar is coming up to the neckline, break above 65.50 is going to be very bullish. The euro, we should be able to trade back up towards 102. Dollar Canadian, should this head and shoulder pattern is going to try to play out. We still have a little bit distance to go before we really break into new trend lows. And the dollar Mexican peso, if this clears 1940, we're probably going to see 19. So those are just some ideas for you guys. Remember, join the ForexAnalytix community.
Blake,
check out the trader funding
has
program.
Not arrived.
What's that?
The guest is not here.
Oh, good. Yeah. Not good for good. It's good for us. Good for us. Good for
Mike
that means you guys don't go anywhere. Let's continue coverage. Dollar yen really breaking down, and this is one that I'm now going to try to sell a rally. If I can get a rally back to 144.50, I am selling. Just letting you guys know.
The guest is here, by the way. I see him. I'm going to promote him.
Okay.
Yeah.
Dang, not good for us. Good for him. All right. I like this guy from an Invictus Macro. Sharp gentleman. So you guys make sure you stick around for that.
Okay.
But look at this dollar yen breakdown. I'm going to sell any bounce in this one now. Any bounce back to 145, 144.50. You can probably layer your shorts in here and just keep your stops back above, 145. Very, very well defined. Oh boy. Look at the market is actually breaking.
Yep.
Wow. Good golly. I love it. All right. At least I got to trade on some other platforms here. All right. Guys, gals, have a great one. Good luck, everybody. You guys know the levels we're looking at. Check out the Trader Funding Program so you can join our community, so you can be with us 24 hours a day. Dale, it's all yours.
Thank you, Blake. Thank you, team. Right. Great coverage of a live event, man.
Thanks, Dale.
Yeah, real good input everywhere. What a team, the dream team. Mike Singleton, welcome back. How are you, Mike?
I'm great, Dale. Thank you for having me.
Oh, great to have you back, Mike. And, this is the news the market's been waiting for quite some time. So what's first on mind for you today? And if you want to share your screen, you know where to do it, right?
Yes. Yeah. So I think first thing on mind has to be the CPI print. I haven't had the chance to really go over it in detail, but if I heard you guys right earlier, it looks like it came in at 7.7, which is, I think 30 basis in year-over-year terms, and that's about 30 basis points lower than consensus. I think on a high level, there's two ways that you can sort of interpret CPI data. One is as a lagging data point for inflation in the past, and the other is as a policy input for the Fed right now. And generally at Invictus, we spend a little bit more time thinking about number two. Are we surprised to see 7.7%, versus 8.0% consensus? A little bit. I mean, that's definitely like lower on the margins than we expected, lower than the Cleveland Fed nowcast. But we're not totally surprised because we've been saying that a rate of change slowdown in disinflation is likely. And one of the reasons that we've known that is we haven't been able to make any money in inflationary assets in quite some time now. And we know that the markets tend to front run the economic data. So for example, the CRB commodity index has been flat since March of 2022. Brent crude has been flat since February. Mining stocks have been flat since February. So if inflation were going to reaccelerate past its June peak, our expectation is that these inflationary assets would be going up, not down/sideways. So, rate of change deceleration in inflation makes sense. It's kind of in line with what the market has been telling us to expect.
Okay. But I do recall, Mike, the last time we talked, your part of your defensive positioning was long bonds. I've never seen a more persistent bear market. Looks like it's trying to bottom out here. You still think bonds are a play? They're probably more of a play than they were a few months ago.
So we're not so much bullish on long-term bonds right now, or on duration risk in general. I'd say if you're looking at bonds, you want to get some exposure to treasuries. We like short-term bonds.
Well, I'm talking about last time, Mike. Yeah. So I know. Am I wrong? I mean, tell me if I'm wrong.
So we did like.
Go ahead.
We did like taking a chance on long-term bonds when rates were sort of approaching their 2018 highs. We thought that would be a logical place to add some exposure with very well-defined risk. But we have to cut our losses, and we cut our losses when rates went above that level. That was our risk management level. So we got that call wrong, and we have no, given the way that the Fed has communicated with the market and the way we're interpreting the current jobs data and the current inflation data, we think rates probably continue to move up for a little bit while longer. So we're not getting long any kind of duration risk yet. Okay. Although, like I said, I think the yield on short-term treasury instruments, 3 months, 6 months, 1 year, even 2 year, very limited duration risk, 4 to 5% yields. We think that's pretty attractive as an alternative to cash.
Well, notes look like they have turned. What's your forecast on yields now? I know some people that think we could see the 10-year fall to 3% or lower.
I have to say, over sort of the intermediate term, over the next, call it 3 to 6 months, it's hard to get, you know, long on the 10-year bond. I mean, it's not to say it couldn't, you know, sort of oscillate around its uptrend for a little while, but generally speaking, there's about an 80% correlation between the Fed funds rate and the US 10-year yield. So as long as the Fed is raising the Fed funds rate, we probably don't want to bet on the long bond, at least not yet, right? And, you know, inflation came in below expectations at 7.7%. It's still almost 4 times the target rate for the Fed. You know, initial claims and other labor market data appears to be at sort of a cyclical strong point. So why would the Fed stop tightening? They don't look at really leading indicators, or at least they don't overweight them analytically. They don't really interpret rate of change data the way that investors do. They've been very clear about what their plan is in terms of policy. They're going to continue to tighten. They're going to continue to raise rates until they see inflation, you know, very, you know, kind of obvious line of sight into that 2% inflation rate. And we're still not even close to that. I mean, it's great to have a, you know, rate of change decline, and that has an impact on inflationary risk exposures like commodities, like we just pointed out. But as a policy input, 7.7% is still way too high. They're not gonna pull a pivot over that, right? And like I said, if that means they're going to continue to raise rates, that's bad for long-term bonds too.
Okay, I wouldn't be short these right now. You know, I wouldn't be short. So looks pretty negative. What we had, I mean, look at how yields handled the hawkish Powell, a strong headline number, and they couldn't take out the 435 level. And now we're back at some support. If we take it out, it looks vulnerable to me. Any view on gold? I know that at times you tactically take positions in gold. A lot of people calling this a very important breakout here above 1680. Do you have a view on that?
So when it comes to gold, we think the thing to really understand is real rates, right? This is like one of the closest long-term correlations in finance and financial markets. And the reason is you can kind of think of gold as non-interest bearing money. So generally speaking, when interest rates are going up, gold tends to struggle. So this is kind of an outgrowth of our view on bonds, like we just said earlier. Our expectation is that rates probably continue to rise as long as we have this situation with inflation in the labor market. And so, you know, I think it's hard to get super excited about gold here. And on top of that, I think when I look at it technically, I would say I would say that support or resistance is around, I don't know, 1730. So we're right below resistance. I would say gold looks tactically more like a short than a long here.
Okay, I'm actually considering trying that. So let me ask you what you are doing and what you're saying in your newsletter, Mike, as far as, you know, we have to catch up from the last time we talked, which was what, about 4 months ago. So tactically, investment themes, what are your views going into year end? Is it just, you know, we'll see book squaring and tax selling, and will the Fed only go 50 at the next meeting? So what do you do?
I think there's a good chance of, I think there is a good chance of 50 at the next meetings, you know, especially given this trend, especially given how aggressive they've been up until now. But 50 is still aggressive, you know, relative to history. Overall, our view is certainly still bearish. We haven't really changed our core view since the last time that we spoke, right? Our expectation
is some defensive. I mean, any positions you had in the market was structured defensively, right?
Right. I mean, I think the best expression of a defensive mindset right now is cash and short-term treasuries.
Okay.
Or that's just to say lower net exposure. If you have a mind to sell short, there's plenty of great short selling opportunities out there. You know, one way that we expressed our defensiveness was through that long-term, you know, bond trade around the 2018 highs. You know, that was a play on growth more or less, right? And growth did continue to slow, but there's cross currents, right? Because the Fed was continuing to raise rates. So the core view about growth was correct. The expression of that view was incorrect. It wasn't the right way to express it. But we've expressed it in other ways, right? Short cyclicals, long defensives is another way of expressing that slower growth view, and that's worked out pretty well since, you know, certainly since the new year. So that's really the core view. The core view is slower growth, slower inflation, and all of the different ways to express that in the asset markets. The most obvious of which is just low net exposure.
Okay. And midterms, politically, does that go into your thinking at all? What happened in the midterms?
So I think first of all, at Invictus, we're sort of a mind that the business cycle takes precedence over the political cycle. Okay. And, you know, there's certainly going to be a lot of news about politics and what's going on and how it's going to affect the economy and how it's going to affect the markets. And I certainly follow all of that. I have to say it's really more signal than noise in our view. And, you know, you could point to a lot of different examples of that throughout history. So, well, you know, an obvious one is the energy sector, right? Generally speaking, Democrats are perceived as a little bit more hostile toward energy and Republicans as more friendly. But if you look at various measures of energy investment under President Obama's tenure versus President Trump's, the energy sector expanded quite a bit under President Obama and contracted quite a bit under President Trump. Did that have anything to do with politics? No, it had to do with the shale revolution and innovations in horizontal drilling and eventually the shale bust. You know, energy and politics go together like peanut butter and jelly, and people always talk about them. But the reality is that, you know, for the last, I don't know, a long while now, or at least through that period between 2008 and call it 2020, the politics was more of a sideshow than anything else. It was the business cycle, it was the fundamentals that were really driving the trends there. Okay. In terms of what to look for politics, there's two things that we really focus on. One is fiscal stimulus and one is regulation, right? Obviously, House, it's now Republican, and the Senate seems like it's still up in the air. The odds are that creates just more gridlock, right? So the odds of any kind of stimulus go down. So that's a deflationary force. Less fiscal stimulus means, generally speaking, slower growth and slower inflation. It's generally bad for risk assets, and it's another reason to be defensive. I haven't seen anything particularly noteworthy in terms of regulation or in terms of different regulatory outcomes that could be a result of this this election cycle, but it's something that I'll certainly be keeping an eye on.
Okay. Say new money came to you right now, and that's right, you're not a money manager, but say for example, what are you telling people to do? Just sit in T-bills right now, mainly?
It's the most boring call of all time, but yeah, probably. Unless you have a mind to go short, you know, then I think, like I said, there are plenty of attractive short opportunities. But yeah.
Do you recommend shorts? In
our weekly trade ideas, yeah, in our weekly trade ideas product, we go through our best.
There's Mike.
Yeah, long ideas and short ideas, and give some commentary on how we're thinking about portfolio management and the markets as well. But yeah, unfortunately, from the long side, nothing interesting to say here.
Okay, so and you're not in the camp that we're getting you know, a turn in the dollar. So this could end up being, in your view, a buying opportunity in the dollar. This dollar weakness we're having today?
Yeah, I have to say that that's my bias, is that the dollar continues to go up. I think rates are going to continue to go up. I think global growth is going to continue to slow. Those two things together continue to make the dollar more attractive. I don't see any reason that the dollar sees anything more than a viable dip.
Okay, and so that's what we'd be happy. I'll be watching the euro around 102. So, Mike, anything you want to leave us with? I'm showing your website. You want to talk about what you do and what you offer now?
Yeah, of course. That'd be great. So at Invictus, we provide a number of different research products. Our sort of flagship product is called the Daily Edge, and that's a 5 to 10 minute video that we send out every morning. It goes over the day's most important economic data and market moves, puts them in the context of the business cycle. It's really meant to be a replacement for the business section of the newspaper. I know certainly when I you know, started in the business, everyone I talk to in the business is obsessed with newspapers, really. And I remember when I first started, my employers told me you should spend the first 30 minutes or an hour of every day reading the newspaper and staying apprised of different financial news. And I always found that to be a tremendous waste of time. Business news is very biased. It's sensational. The journalists don't do a good job of connecting what's happening in the economy with the markets. And so the Daily Edge is an attempt to sort of resolve that on behalf of investors.
You curate it for them, save them time.
Curate it, right, exactly. Focus on what's important, explain why it's important, what the implications are for tradable risk exposures using back tests and charts that are really easy to understand, and really do a lot of the legwork for people that they don't want to have to do themselves, right? I think that digging through government data and putting together graphs and charts is it's really boring for a lot of people and they don't like doing it. And Invictus, we love it, so that's our business.
And you have an educational section here that you're going to teach people to look at the things that you look at and learn how to invest like a hedge fund professional.
Right, exactly. The whole idea being, look, we can go through all the historical data for you. We can run all the back tests, all the correlations, so that you don't have to do it, right? Like understanding market history is incredibly important, but incredibly time consuming. And a lot of people just don't have the time to go through it. And so, we do it for you, and we try and communicate it in a way that's very easy to understand, very little finance jargon, and really puts all of the complexity of the economy and all the data that comes out into perspective.
Okay, so Mike Singleton, a watchman who also teaches what he watches. I really appreciate you being here, Mike. Best way for people to follow you on Twitter, they could get a hold of you, or where on the website can they get a hold of you?
Yeah, so invictus-research.com is our website. That's where you can probably learn the most about the business and look at the products and so on. Or you can follow me on Twitter @InvictusMacro, and we occasionally post some charts there and some analysis and stuff like that. So I think that's I'm biased, but I think that's a worthy follow too.
Okay, and if you follow Mike, you're definitely is going to watch your back on risk, so you don't have to jump off any of these buildings that are on the cover. So Mike, thanks for being transparent, authentic. Everyone's wrong once in a while. The key is, how do you lose? And pros know how to lose, so they have money left to be right with. So appreciate you being here today and filling us in. And sounds like pretty much the same theme that we had. No green light on this being over. Would you say we're in about the 5th inning and this is going to go on for another year? This kind of macro?
I think that's a good way to put it. I think, why have risk markets really struggled? There's really 2 reasons that can happen. There's the Fed tightening monetary conditions and raising real rates, and causes multiple contraction in stocks. And then there's the growth cycle, right? And right now, a lot of the damage that we've seen has been from the Fed. Growth is slowing a little bit. It's not helping. But the Fed is really responsible for a lot of the damage that we've seen. In our view, the growth cycle is maybe in the 4th inning of cresting. And when growth really slows quickly, we haven't seen a really big earnings down cycle ex-COVID since the great financial crisis. And if we do see that, and that is our base case at this point, policy and real rates and all of that are probably going to take a backseat. It'll be the earnings cycle that's driving stocks. And according to our leading indicators and forecasts and whatnot, it could get pretty ugly.
Yeah, that would really perplex people. Is say for example that chart that I was showing, that yields really do begin to drop, and it doesn't help the market because yields are dropping because of exactly what you're talking about, a big growth scare, and doesn't support stock prices. I think that would catch people off balance, don't you think?
That's exactly right. And I think long bonds will perform when that starts to happen. So I'm completely open-minded about going long, the 10-year bond or the 30-year bond again. It's just sort of a matter of, tactically, when does the market start to price this in? When does the economic data start to show it? When does the Fed acknowledge it, right, that the economy is slowing and that it's likely to start slowing quickly? So I'm with you on the, in principle, on the long bond trade, but we just don't think it's yet.
Okay, and I know I was going to let you go. Can you explain to me why junk looks better technically, and that's all I know, than treasuries, and even corporates look better than treasuries?
Well, yeah, I think it's because credit spreads haven't widened all that much. They've widened a little bit, right? And what do credit spreads trade on? They trade on growth expectations. They trade with a very close correlation to the ISM manufacturing PMI with a 1-month lead. Right. So growth is slowing. Credit spreads have widened a little bit, but it's not slowing that much. So we haven't seen the big blowout yet.
Okay. All right. Appreciate it. My trading warrior brother, Mike Singleton. Check out Mike, read him. He'll keep you straight in case you get caught up in hopium. So Mike, rooting for you. Have a great quarter, and I'll get in touch with you and keep you in the rotation. Okay, buddy?
Yeah, my pleasure, Dale. Thank you for having me.
All right, Mike Singleton, everybody. Thank you for being with us today. And everyone, you could join the team in 20 minutes on the Morning Edge. Don't just count your consumer pain indexes, count your blessings, and good luck the rest of the day. That's it. We'll wrap it up on TGIF tomorrow. Adios.